You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This Week in Futures Options is also brought to you by FTSE Russell, a leading global provider of benchmarks, analytics, and data solutions. For more information, please visit ftserussell.com, cboe.com, and cmegroup.com. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody. That music may come as a little bit of a surprise to you today. Yes, it's time for TWIFO. You may be scratching your head saying, wait a minute, what's going on? I like my Thursday TWIFO. Well, that's still our normal day. Just coming at you with an extra special, very special edition of the Wednesday TWIFO here this week in Futures Options. My name is Mark Longo from the OptionsInsider.com, as well as, of course, from the ever-exciting, at least we hope so, Options Insider Radio Network, coming at you pretty much multiple times a day. So if you like TWIFO, you're going to like all the other programs we've got on the old network. Make sure if you like what you hear, keep those reviews coming. In these troubled times, more important than ever, people are stuck at home. The news is pretty dire. They're looking for outlets for informed information on these markets. We'd like to provide that, so keep those reviews coming. Keep those questions coming, too. We do love to hear from you guys. Let's see who we're going to hear from on this extra special Wednesday edition of TWIFO. First, let's go back out to the FTSE Russell hot seat, where we are joined once again by our old friend, Mr. Sean Smith, the Managing Director of Derivatives Licensing over there at FTSE Russell. Mr. Smith, welcome back to TWIFO. Do you have to look around and pinch yourself saying, what's going on? It's not Thursday. Is your whole week in flummox now, sir?
It is. And just the fact that we got to move the show to today enabled me to join. So I'm just very, very happy to be here, as I always am. And I'm looking forward to a fantastic show today.
Yeah, it should be a fun one, because you're also joined for our, let's say, semi-annual guest appearance in the CME Group hot seat by our old friend over there, Mr. ERIK NORLAND, the Executive Director and Senior Economist over there at CME Group, beaming in from across the pond. Mr. NORLAND, welcome back to TWIFO, sir. It has been too long.
Thank you so much for having me. It's always a pleasure.
Well, we love having you on because you come armed with the latest data, the latest research across an array of products I'm chomping at the bit to get going, but first we have to kick it off the way we always do. It is time for the Movers and Shakers Report.
It's time to find out what's rallying on the light side and falling to the dark side at CME Group this week. It's time for the Movers and Shakers Report.
All right, everybody, you know what's happening now. Maybe a different day, but the show's format, at least, still the same. Movers and Shakers going to break down what the big movers were this week across the broad trading pantheon at CME Group. It covers a wide range of products. Mr. Norland, as our CME hot seat guest today, sir, you get the pride of place. You get to choose where we begin our journey. So we look to the light side first, a.k.a. the products that are rallying this week, or to the dark side, the ones that are falling in the red, sir?
I think we should begin on the dark side.
I knew I liked you, Eric. I knew there was a cut of your jib.
Wow.
Something resonated with me.
Never underestimate the power of the dark side.
I knew I liked this, man. Sean, cover your ears. This may be a little bit too much for your sensitive light side ears. All right, we're going to kick things off to the dark side as requested. It's actually an interesting week out there. You know, many weeks over the past couple of months, we've seen just a strong trend across all the markets. 90% of them are up, 90% of them are down. It's kind of hard sometimes to even put together a bottom or a top five. This week, not so much. It looks pretty much, I wouldn't say back to normal because nothing is normal here in the year of 2020, but at least from a distribution perspective, the markets seem to be a little bit more on an even keel, pretty much 50-50 in both directions. Again, to the dark side first, feeder cattle. Not a good week for the old livestock here. Feeder cattle off 1.63%. Number 4, wheat off 1 and about 2/3%. Number 3, soybean meal off about 2 1/3%. Lean hogs off 2.35%. So just edging out the soybean meal there. And number 1 to the dark side after having quite the run to the upside of late, Bitcoin. You guys are always asking, where does Bitcoin fall in our movers and shakers? Well, there it is. Number 1 to the dark side. By the way, wheat, number 4 this week. That was number 3 in the same direction last week. It was off 4.8%. And number 1 in the upside was Bitcoin, and now it is number 1 to the dark side. So reinforcing that old chestnut that Bitcoin a wee bit volatile these days. It was up nearly 16% last week, given a little over 6% of that back this week. Now let's go to the upside here. Number 5 to the upside, Sean's direction. Eurodollars up exactly 2.5%. Number 4, our old friend the Russell 2000 up 4.3%. It was number 10 in the wrong direction last week. Number 3, we got oats up a little over 7%, about 7.07%. Iron ore, number 2, up about 8.7%. And number 1 with a bullet to the upside this week, lumber up 12, nearly 13%, about 12.8%. Lumber was number 5 to the upside last week, and iron ore was number 4 to the upside last week. So both of them continuing their trends, just building upon them ever more substantially. All right, Eric, you always come armed with just a slew of data, a slew of research covering just about all the topics that are trading over there and all the products that are trading over there at CME Group. So it's almost impossible to choose. So what do you say we just go in order? Does that sound good? Like your most recent research, sir? Does that sound like a plan?
That sounds great, yeah.
Werewolves beware. It's time to explore the options activity in silver, gold, and other shiny things. It's time to talk metals.
All right, so let's kick it off then. In the metals complex, you put out an interesting piece. You listeners may have just seen it right before showtime here. This actually gets back to a listener question I believe we had on the show last week or the week before. People have been very fascinated with everything going on in the metals side of the fence. In particular, silver has really captured a lot of people's attention of late. It certainly has rallied quite a bit than we saw. And gold, of course, had rallied, then gold sold off. Silver performing kind of a little bit differently these days. And you had an interesting piece out now kind of tracking the whole gold-silver price gap out there, talking about how gold was outperforming, then silver kind of caught up, and then gold driving it back. Some one of your interesting research videos. So maybe if people are intimidated, Eric, by the full articles you guys post, which I don't think they should be, they should go check them out. Great visuals there as well. But if they want to check out one of maybe the more bite-sized videos, this is one of your more recent concoctions here, Eric. What was going on with your gold-silver price gap video?
So basically, I mean, I think it's an interesting story. So if you look over the last, say, 30 or 40 years. On average, gold has bought, 1 ounce of gold has bought about 75 ounces of silver on average. But earlier this year, when silver kind of hit bottom, both in terms of dollars and in terms of gold, 1 ounce of gold was buying 120 ounces of silver, which was sort of like a record high. Nobody had ever seen gold so expensive relative to silver. And as the rally began in late March and April with this massive $3 trillion in 3 months quantitative easing, the price of gold went up 42% versus the dollar, which is great. But the price of silver went up 150%. And so that gold-silver ratio went from gold buying 120 ounces of silver right back smack to its historical average of 1 ounce of gold buying 75 ounces of silver. And so gold had done really, really well in the last decade. And when silver hit its peak, its all-time high in 2011, at that point, gold was only buying 30 ounces of silver. So gold went from 30 to 120 back to 75. And in terms of options, that just blew out the implied volatility on silver. Silver options have always been a little more expensive than gold, but they're still a lot more expensive. The ratio is almost like 2 to 1 now, where normally it would be more like maybe 1.5 to 1 in terms of the cost of options.
Let's break down some of that for ourselves. You guys can do it as you're listening right now or wherever you're listening to this program after the fact. Listeners, head on over to that cmegroup.com/TWIFO or /TWIO link. Either one should work. And head on over to the metals, get into the precious category. We'll kick things off really quickly. So let's do both so we can compare and contrast as Eric is doing here. Let's start with the big dog, gold. Again, we're coming at you a little bit earlier here. It's only about 92,000, not quite 100,000 contracts on the tape here through Wednesday so far. Again, normally we record the show on Thursday, listeners. Most of the action coming in the Jan contract this week, exactly a third of the paper going up in Jan out here. Let's go out to the vol. Eric was just talking about it. Gold vol has always been a bit of an interesting bag. Eric first came on our research radar here on the network when he put out the well-timed piece called Gold Volatility, A Storm on the Horizon. I'm probably mistitling your research there, Eric, but it was well-timed nonetheless because we saw quite the storm of gold volatility ensuing. It's richer now, 16 and a third or so, but gold vol has always been a little bit of a weird kind of short-lived bag. It doesn't really maintain its peaks too often. It's kind of unched this week out here. So again, coming into Showtime, by the way, gold at about 1844 to give you some frame of reference. Let's look really quickly at the skew and then break down some of the hot trades, and we'll compare and contrast with silver really quickly. The puts last week were a little bit bid, 1.7% rich to the at-the-money. This week, about 1%. So coming in a little bit on the put side. Calls, about 2% rich last week. This week, about 2.5%. So calls getting a little bit of a bid. Puts coming in a little bit. And let's see out here. The most active contract this week in gold land, we're at about an 1844 in the futures. Looks like it was the 1900 calls. So maybe some folks leaning on some upside yet again. We always know there's always a funky strike or two lurking out there in gold as well. Yeah, the 2500s were trading pretty actively in Dece of 2021, about 2300 going up there and a few others. Let's look really quickly. I don't want to spend all the show on the metals, but let's do it really quickly on silver as well. Because silver, I know, has fascinated a lot of you of late, and understandably so. It has been moving quite a bit out here. Let's go out to silver and see what we're looking at. Eric was just talking about the premium in terms of implied volatility. Most of the action in silver options coming in Jan this week as well, a little over half. By the way, by point of comparison, almost 100K on the tape for gold options, silver options at about 11,000. So obviously a much lighter product. And about half, 51% of that coming in the Jan contract this week. We just talked about a 16 vol in gold in Jan. It's about a 33, almost 34. It's a little over 2x the vol out there in silver. Getting back to Eric's point that a little bit more juice to be found in the silver land out here. Let's look at the skew really quickly. The puts about 4% cheap to the at-the-money, so a little bit different skew as well, which is kind of interesting. This week, they were about almost 5%, 4.7% cheap, so puts getting cheaper. The calls, 7.2% rich last week. This week, 6.7%, so calls coming in a little bit as well. Vol pretty much stayed the same, off about half a point, so it wasn't a huge vol change that caused that out there. And so we're coming into Showtime. We're at about a 24% 0.1 or so out here in silver, and it looks like the most active contract are the 31 calls in January. So upside afoot in both of them, in gold and in silver, a little bit more extreme perhaps on the silver side. Eric, any of that surprise you, breaking all that down? Is that pretty much what you expected, sir?
Yeah, that's pretty much what I would expect. I mean, basically, U.S. Congress right now is attempting to negotiate a $900 billion relief program. They're not calling it stimulus, they're calling it relief, which I think is actually accurate because so much of the economy is hurting so badly right now. But basically, that $900 billion would take our budget deficit, which is currently 15.8% of gross domestic product, and take it to over 20% of GDP. That's a bigger deficit. It's twice as big as the budget deficit we ran in 2010, as I'm sure in 2009. As I'm sure you remember, back in 08, 9, and 10, the price of gold was soaring. Price of silver was going way up. And the Federal Reserve, the last time Congress appropriated a couple $1 trillion in March, they essentially bought all those bonds. So the Treasury issued trillions of dollars in additional debt, and the Fed stepped up and they bought a large portion of that debt, plus in addition to that, some mortgage bonds, corporate bonds, and state and local government debt. If the federal government now issues another $900 billion in additional debt, that not only expands the budget deficit, it also gives the central bank another opportunity to step in there and accelerate buying, which they may or may not do. We don't know. And we also don't know if this package is going to get through Congress. There's a lot of very contentious issues, dealing with liability protection, as well as aid to state and local governments that have to be resolved before this thing goes on to get signed. But nevertheless, it at least offers the possibility. I think this is what those call option traders are either nervous about or optimistic about, depending on your viewpoint, is that we get another massive expansion of the budget deficit, which gives the central bank an opportunity to create more dollar currency and buy bonds, which in turn sort of devalues paper currency. And it's not just the dollar. The Europeans now doing a $2.2 trillion, so about 1.8 trillion euro stimulus package at the European level, in addition to the 700 billion euros that they did last July. So that's another big fiat currency that's slowly kind of getting devalued.
He touched on a lot of the different areas there that we're going to get to here, Eric, which is why I like talking to you. You always have so much research that's spanning so many different products. And the most recent other product you put out outside of that kind of metals quick hit was about a week ago on central banks. Everyone thinks of central banks as, tamping down inflation, keeping rates in check, and all the sorts of typical central bank business. You looked at it through a little bit different lens, the lens of, have they done a good job containing the volatility across their various markets? Your analysis looking at different products was, I guess you can do a bit of a shoulder shrug. It kind of depends where you look. Some areas have done all right. Other areas, notably equities, probably a little bit less so. But you looked at it short-term, long-term volatility, short-term rates and currencies. You broke it down at maybe a little bit better job there. Also, maybe a little bit decent job of containing some of the credit spreads. But in a lot of the areas, a lot of our audience likes to trade, including the equities and the aforementioned metals, maybe not so much. So break it down, Eric. I like this a little bit different lens of looking at central banks, not just the old inflation hawk adage, but actually, have they done a decent job of clamping down on volatility, Eric?
Well, I think central banks have a really big role with volatility that's sort of poorly understood. When central banks withdraw liquidity, when they raise interest rates, flatten the yield curve, or reverse QE, you tend to see volatility eventually rise. It takes a little while, but it's sort of like you can imagine like the liquidity being like a bathtub full of water, right? So when the central bank pulls the drain on it, the water starts to drain out, and then it starts getting more volatile as the bathtub starts getting empty. Well, now they're turning on the spigots. They're trying to fill up the bathtub full of liquidity water, if you will, which should, in theory, start tamping down on volatility. And they've only been at this for 8 months, which isn't really a long time in the grand scheme of things. The Fed went from shrinking its balance sheet in 2017, 18, and 19 to vastly expanding it this year. And so far what they've done is they've managed to kill volatility at the short end of the yield curve. So there's no volatility hardly left in Euro-dollar futures or in 2-year treasuries. 5-year U.S. treasuries are at record low implied volatility because nobody believes the central bank is going to raise rates in any kind of near-term time horizon. They could be wrong. Maybe they will, especially if the economy soars in 2021 with the vaccine, et cetera. But for the moment, nobody sees that happening, or very few people do. So people think that's very low risk. When you get up a little further up the yield curve, the Fed actually has gotten the 10-year treasury implied volatility down pretty close to a record low. But where they're not able to do it is at the extreme long end of the yield curve, the place where they have the least influence, which is up at 30 years. 30-year implied volatility certainly off its peak from the year, but it's substantially higher now than it was, say, 12 months ago or 18 months ago. And, as you mentioned, the Federal Reserve has managed to get credit spreads back down. And we don't really think of credit spreads necessarily as being an option, right? It doesn't trade at CME. You can't buy corporate bonds at CME or whatever. But what's interesting about it, though, is that they are options. When you buy a bond on, say, a major corporation, what you essentially have is a payoff. It's like a U.S. Treasury plus a short put option. And so when the Fed goes and buys a lot of corporate bonds, they're essentially writing options. And the same thing when they buy mortgage bonds. When they do QE, part of what they're doing is they're buying mortgage bonds as a very substantial portion of the QE, and corporate bonds through ETFs has been a smaller portion. They're essentially funding the options market for those kinds of goods, which tends to depress volatility. You also rightly mentioned that there's not a huge amount of volatility in the currency markets. There was a spike in volatility when there was a dollar funding crisis back in March. But that crisis lasted, I would say, about 5 or 6 days before the central banks really got on top of it. They put in massive swap lines, and they basically said, if the private actors in the market won't lend you dollars or euros, we will, and we will lend it at a great price. So currency market volatility is very low. But where the Fed really doesn't have much control is on stuff like equities. The S&P volatility is obviously way off its highs. We're still at VIX is still at 20% implied volatility, which is pretty high. NASDAQ volatility is even higher, probably in part because people are so nervous after the huge run-up in that index. But then lastly, you have the precious metals. And so in some ways, the Fed's clamping down on volatility in paper currencies, whether it's dollar and other currencies or whether it's short end of the yield curve, has meant creating gigantic liquidity, which is in turn threatening to devalue not just the dollar, but basically every fiat currency, the euro, the Canadian dollar, the British pound, the Swiss franc, et cetera, Japanese yen. All these central banks are creating massive amounts of liquidity. So the problem is you might see their currency starting to lose value further against real assets like gold and silver. At least that's what these gold and silver call option buyers might be afraid of in any case. And so that's what I think is really keeping this volatility in precious metals quite elevated.
When you mentioned volatility across the yield curve, you're right, not a lot to be found in the narrower portion of the curve. But I like when you come on, Eric, because we get to explore maybe some products we don't always get to put into the rotation here on TWIFO. Let's get out a little bit farther on the old yield curve. Let's go out to the 30-year and hang our hat out there a little bit. That 30-year coming into Showtime at about a 172 coming in here on the futures here. Let's look where the action was. By the way, if you're wondering how much paper goes up in the 30 years, decently active, about 217,000 contracts on the tape. So a heck of a lot more than silver and pretty much double what we just talked about in gold on the tape here so far on this special Wednesday edition of TWIFO. And most of that action, about almost 41%, coming once again in Jan. Jan is the hot contract out here this week. Let's go out here. Let's see. The vol, by the way, Eric talked about not a lot of vol in the narrow portion of the yield curve, and he's right. It's about a 3 on those nearer term contracts. It's about as anemic as vol can get and still exist in the trading product. A little bit more juice, not a ton, but a little bit more juice to be found out here on the old 30-year. The Jan contract's trading about an 8.2. and some of the narrow term contracts that are going out in a couple of days. And again, that's not really vol, it's more gamma, but still, they're at about a 10 and a half or so. So talking 2 to 3x more vol on the longer term portion of the curve than we're seeing at the narrow term portion of the curve, which makes it a little bit more interesting from a vol and options trading perspective. Let's look at the skew out here. Last week, the puts were a little bit bid, 1.5% rich to the at the money. This week, they've swung a little bit. They're about a point cheaper. So they've come in about 2.5 points, which is kind of interesting. And the calls are about almost 1.5% cheap to at the money this week. They're about a point, about 0.9. So the calls getting a little bit of a bid, and the puts coming in quite a bit, which is kind of interesting out here. Let's see what the most active contract is out here in all things 30-year. It was, I mentioned, we're at about a 172 and change coming into showtime. The 170 put is where actually I take it back. It's 170 put as well, but it's in February where the little bit more has gone up to the tune of about 15,000 and change, 14,000 and change having gone up in Jan. Either way, no matter which month you're looking at, it's the 170 put that is leading the dance out here in the 30 years, and we have to keep on dancing into our next product. Eric just talked about central banks maybe not doing the best job of containing a volatility in equities. I think we'll hang our hat there next.
It's time to explore the volatility swings, skew changes, and hot options trades in your favorite indices. It's time to talk equities.
All right, everybody, welcome to equities. You know what we're going to talk about now. We're going to talk about the vol and all the good stuff going on in your favorite equity products. Let's set the stage. Coming into showtime, we saw our old friend RVX, a.k.a. the VIX of the Russell 2000, a little bit north of 29. It was about 29.1, up a little more than half a point from last show, and not that far within spitting distance of the recent high it set out there not too long ago when everything was selling off, back at about 31 and change. So about 2 points away from its recent high out there in small cap vol, which is kind of interesting. VIX also kind of unched from our last show. Is about a 21 coming into showtime, puts it down about 1/4 point, which is pretty much effectively a rounding error out there in VIX land. VVIX, a.k.a. the volatility of volatility, trending up a little bit, up about 5 points to 110. And then the newest addition to the volatility trading landscape, a.k.a. VOLQ, a.k.a. the at-the-money vol of the NASDAQ 100 out there at about 22 3/4. Puts it up about 1.25. So NASDAQ vol ticking up a wee bit since our last show. That puts that VIX to RVX spread, a.k.a. the large cap to small cap vol spread, keeps widening out, but probably a lot of that having to do with small caps continuing to look juicy. 8.1 points is that now. So over 3/4 point wider as small caps continue to outpace from large caps from a vol perspective. And the S&P to NASDAQ spread, the VIX to VOLQ spread, again, that's not quite apples to apples, a little bit different beasts there, but interesting to watch nonetheless. That's not quite 2 points. That's about 1 3/4 points, puts it in about a full point. So that's come in quite a bit, the S&P to NASDAQ vol spread. Let's go out to small cap land. Mr. Smith, I know you guys have been busy. Everyone, it seems like I'm talking to, outside of you, it's your job to want to look at small caps. But a lot of people are coming at me who it isn't their job, Sean, and all they want to talk about is small caps. We had Matt on last week talking about the skew and the 5 delta calls. We got a bunch of our other hosts on other shows talking small caps. It does seem like small caps have captured the mind share these days, Mr. Smith. Is that the case in your neck of the woods as well, sir?
It is, and you're absolutely right, Mark. Small caps have just captured the attention of the investor community in a big way in these last few weeks, especially November. They're calling November for Russell 2000 the November to remember because of the rally in small cap stocks throughout the month of November being at a all-time record for the index, being up 18.6%. I'll let Eric talk about the economics and drivers, but things to take note are the various sectors within small caps. So far in the year 2020, there's been 30 IPOs, 30 IPO additions to the Russell complex, and almost half of them have been healthcare stocks. And healthcare has actually done dramatically well, driving small caps up. Those being the domestic healthcare stocks here in the U.S. that are benefiting, one from a possible economic stimulus package, but also the news of a vaccine, and that healthcare stocks have been of focus in the near term as well. So very interesting. And the bigger overriding factor is that the Russell 2000 is an indicator of a stronger indicator of the U.S. economy in terms of it being, more domestic in nature. But yeah, really interesting times. Last week, Matt was on talking about upside call buyers and record volumes as well in small caps, and really interesting. And obviously, that's why we're seeing RVX where it is in regards to the other large cap indices, volatility falling. So really interesting times. Volumes have been fantastic in terms of futures and options and CME Group in both the mini and the micros, record volumes, record open interest in the minis as well. So that's a strong indicator of investment confidence in the market, and a strong indicator of there being a great risk measure and trading vehicle at CME Group. So exciting times. Eric, it's fantastic to be on the show, and I'll let you talk about more of the economics of the equity space.
Well, Eric, Sean just mentioned it. We haven't had you on in a little bit. So I know for a lot of people, yourself included, the election was a big volatility event to analyze the vol leading into it, the vol coming out of it. You had an interesting piece not too long ago called More Caution in NASDAQ Than Other Markets, looking at, of course, the latest addition to the CME offerings as well, which is, of course, the VOLQ and how that's fared pre and post election. That's certainly been a fascinating time. So maybe let's start there, because we haven't had a chance to talk to you in a little while. What are your thoughts on how vol performed heading into the election, and maybe perhaps more surprisingly coming out of it there, Eric?
Yeah, there's a lot of interesting issues with respect to equities and how it interplayed with the election. But, I think what's really, really interesting is how high the NASDAQ's volatility has become with respect to the S&P 500 in particular. Not particularly around the election, but especially in that massive rally we had in the NASDAQ from kind of the end of March until the first days of September. That's what I think really expanded out that volatility. Everyone was watching the FANG stock that drive the NASDAQ have this gigantic rally, and people were really nervous. There was a lot of buying of options on that. Some projecting in a sense that it would continue, other ones fearing that it would not continue. And so then in early September, we had this really nasty correction in the NASDAQ, and that kind of reduced the spread between the VOLQ and the VIX, or between the NASDAQ and the S&P 500 options. And then it started to expand out a little bit again after the election. And with respect to the Russell, getting back to the earlier point here, the Russell 2000 is absolutely, as you said, a really closely linked to the state of the U.S. economy. And so the Russell really got hammered harder than the other indices did in February and March, and then it recovered much, much more slowly. But what's really kicked the Russell into high gear, I don't think it's anything to do with the election, it's the vaccine. The big companies, like the ones that dominate the NASDAQ, like everybody's going to keep using Facebook and Apple and Amazon, irrespective of a pandemic, right? And Google, et cetera. But a lot of the smaller companies are very, very connected to consumer demand. They're much more bricks and mortar kinds of businesses, and they were very badly hit by the pandemic. So for them, a vaccine is just an absolute miracle. It's really the best possible piece of news. Up until the 9th of November, the Russell 2000 had been moving in lockstep with consumer spending. And suddenly it peeled off, going up about 20% or more in the past month. And that's, I think, a direct result of the vaccine. So I think it's going to be very sensitive to vaccine news. If there are, say, distribution problems with the vaccine, or if the vaccines have to, somebody has, like, say, allergic reactions or negative reactions to the vaccine, there's a lot of downside vulnerability among small cap stocks in particular. On the other hand, if the vaccines, are successfully distributed and a whole, large portion of the population is inoculated, and we have a lot of stimulus coming out of Washington, the small caps, I think, will be the primary beneficiaries, whereas these really big companies that dominate NASDAQ I don't think it really changes the picture so much for them.
Well, let's look out at some of these equities. Since you touched on NASDAQ, I don't get a chance to talk about NASDAQ options too often here on the show. So let's kick it off out there in the E-mini NASDAQ 100 on the equity side of the front. If you're wondering how much paper they do in a week right now, coming into our special Wednesday show here, about 18,000 contracts and change. So not blowing the doors off, but not nothing either. Let's see, about almost 40%, about 39% of that coming in the regular old monthly DEES contract that goes out in about 9 days or so out here. So kind of hard to parse vol. But if you're wondering how that at the money vol out there lines up with the VOLQ is at about a 22 3/4, and we're seeing that about a 21 out here in that DEES contract that has about 9 days to go. So pretty close. Interesting how those two line up. Skew-wise, let's go maybe a little bit farther out so we can just look at the skew. Jan was also a pretty active. The puts out there in Jan, and then the other way, that vol in Jan's about a 24. So interesting little spread between about 21 and a 24. You go a little bit farther out there. The puts in Jan, about a 17% rich to the at the money. That's pretty steep. Last week, this week, about 15.5%. So they came in, obviously, a little bit. Calls 11, almost 12% cheap to the at the money, and then catching a little bit of a bid this week to about 9.6% cheap. So interesting swing out there. In terms of where the action was this week, I said we're at about a 12,538 coming into showtime in the NASDAQ, and with the 13,500 calls. We're leading the dance out here in DEES with about 9 days to go. So of that, about 18,000 contracts, 2,000 of them coming on the 13,500 calls. Looks like most of that was closing on Mondays. Maybe someone deciding that was a bridge too far. Either way, someone getting the heck out of Dodge on the 13,500s here in DEES. Let's look really quickly. You also talked about small cap. Let's see what's cooking in Russell 2000 land here really quickly. Again, getting out here to all things small cap. It's been, like I said, on top of mind for a lot of people. We just had Matt on the show last week, focusing specifically on those 5 delta calls in the Russell 2000. If you missed that show, go check it out, listeners. Kind of interesting stuff. Not an area we usually spend a lot of time on. Usually it's a little bit meatier options in the call and put skew we focus on. We thought the 5 delta calls, the extreme wings in particular, were very fascinating out here. Coming into showtime here at Russell 2000 at about a 1918. So, Sean, we were just talking about when the Russell 2000 hits 2000, maybe having a big party. Getting closer to that level this week, up about 1.5% so far this week. And about 45% of that paper coming in also near-term DEES contract with about 9 days to go. And it seems like the big dog out here was the 18 half calls. So, in the money calls now. That's kind of interesting and a big change from what we see typically in the Russell 2000, which is usually longer term, so at least 3 months, maybe around 6 months, and pretty far out of the money puts dominating the tape. This week, a complete reversal of all of that. It's near term, and it's in the money calls. So maybe some of that reflecting this big movement we're seeing out there of late. Folks pile into some calls that are now already in the money. So I guess good for them if they were buying those. Vol-wise, mentioned our RVX at about a 29. And let's see, that front contract vol is at about a 27. That's only got 2 days to go. Then instead we're talking about a 25.5, 26 as you get a little bit farther out there in the small caps. And we got to keep on rolling. We could talk about a lot of other products here, but I know you guys like to talk about the old Texas tea.
It's time to tap into the deep options well of black gold, Texas tea, nat gas, and more. It's time to talk energy.
This has been another fascinating area of research for you over there, Eric, looking at all things crude oil. You know, this has been, I think you could probably just devote all of your time this year to just crude oil, just given the enormous swings we've seen over the year. Of course, what happened and the underlying supply and demand when it all went negative earlier this year. And of course, the ongoing saga that has been crude oil demand. You know, it kind of vanished for a while there as all the planes were kind of grounded. No one was going anywhere. No one was driving. No demand for crude. And now you think that may be changing now that we're seeing vaccines on the horizon, Mr. NORLAND. So walk us through some of your latest research on crude oil demand, sir.
Yeah, so I think that the prices obviously spiked a lot in recent days and the last couple of weeks because OPEC has been so disciplined so far about maintaining its production cuts. But I think that what makes me nervous about oil is that we're still not even technically to winter yet, which I know is crazy because it's so dark out in the northern hemisphere. But nevertheless, we're not really to winter yet, and yet, we have parts of the United States now moving back to lockdown. Europe kind of going in and out of lockdown depending on the country. You have COVID spreading again now a little bit in Japan. You have Hong Kong that kind of goes in and out of lockdowns. So even China doesn't seem 100% immune, even though they've obviously been pretty successful at controlling it. COVID cases are soaring in Russia. They're rising again in Brazil. So I think it's just going to be a really unpredictable winter for the Northern Hemisphere in terms of oil demand. And you have to remember, 90% of the population in the world lives in the Northern Hemisphere. When you look at air travel in the U.S., it's still down 65% year on year for the last week. And I think we're heading into a pretty tough spot here. So I think oil demand is going to be really weak. Another thing that's I think of concern is that oil inventories remain exceptionally high, especially for crude oil, but also for ultra-low sulfur diesel. And even gasoline inventories are slightly on the high side. They're not as dramatic as the other ones. But basically, you have really kind of weak, unpredictable patterns of demand, high inventories. That's not great news for oil. The only really piece of good news there is that the oil producers are, for the moment, maintaining discipline. But even there, you occasionally hear threats. Like we heard the UAE threatening to back out of OPEC. That may have just been posturing designed to get other people like Iran to the table. But Iran is now planning to increase production. And you have the whole sanctions issue. So it's, I think it's a really pretty unpredictable season for oil.
Let's go on out to crude oil right now. See what's lighting it up out there today. You know where to go, cmegroup.com/TWIFO. Go to that drop down. Go to energy and then WTI, and you're off to the races at about a 45 3/4 coming into showtime. So a wee bit north of that much maligned 40 handle out there right now. 33% of the paper coming in that Jan contract that has exactly 7 days to go. Once again, putting aside the lie that people won't trade weeklies in WTI. They will trade short duration contracts that have a week or less to go. They just won't trade a listed weekly for whatever strange reason, and we still have yet to uncover several years here into doing this program. So let's see how much paper on the tape this week. About 250,000 contracts on the tape so far this week. So a pretty active week out there in WTI. We've said about a third of that coming in the Jan contract. We know we hate to analyze skew, though. So close to expiration. Let's go a little bit farther out. 25% of the paper went up in the Feb contract. That has a nice, what do we got here? It looks like a nice 36 days to go. So that's well within our frame of reference for analysis. If you're wondering, at the money vol at about a 33.5. So pretty frothy, well off the 60-odd level it hit not too long ago. So crude vol has come in quite a bit, but it's still frothy. It's off about another 0.75 of a point this week. And going on out here, let's see. Let's look at the skew in February here. The puts were 12.3% rich the at the money last week, 12.4% rich this week. And the calls, 7.7% cheap last week, about 6.9% cheap this week. So not a lot of evolution on the skew front, which is kind of interesting. The calls are still offered, so they are continuing to fade this a little bit, but nowhere near as aggressively as it was. Pretty much every time it would blow through the 40 strike, those calls would be 10, 12% cheap to the at the money. Not quite seeing that anymore. Vol has come off a little bit, obviously, as well, so that has something to do with it. And the fact that we have blown through a lot of those short strikes north of 40 also having something to do with that. The number one trade out here this week, the 50 strike calls going away in January. So in 7 days, doing, looks like about 6,500 contracts. That was the big, no, actually take it back. It was the 40 puts in February, the aforementioned February, doing about 8,300 contracts this week. That was the big dog out here. Looks like pretty evenly split every day, about almost 3,000 contracts. So they've been pretty active all week long. Maybe a sign that, going back to that fading level. People think we're going to retreat back below 40. Maybe. Either way, 40 puts the number one trade out here this week. So maybe that, all you've been asking about, what's going on with this 40 strike, are people fading it? Maybe all that action on the 40 put strike will tell you. Also, June double calls, June 55 calls, also very active. About 7,100 of those on the tape this week. The lion's share yesterday and today, about almost all the paper going up in these past 2 days. Slightly closing yesterday. Obviously don't know about today, but the double calls, maybe showing maybe the other side of that range, maybe a little bit of optimism going up out there. I like to go a little bit longer term out here in crude oil just to see anything else weird on the tape. If you go all the way out to Dece of 2022, someone putting up about 2,000 of the 32 half puts. So an interesting strike to look at, a lot to parse here. Eric, we're kind of coming up against it. I want to make sure we get some of our listeners on too. But before we go out, some of their listener mail, you've done obviously a lot of research. We can't encapsulate it all here on the show. Any other product that really jumps to mind, or recent research paper that you think would really resonate with our audience, sir?
Well, I think the one asset class we haven't talked at all about is ags. And one thing I think is interesting is we now have a pretty strong La Nina happening in the Pacific Ocean. La Nina has created a lot of crazy weather events in the past that have tended to be pretty unfavorable to crop yields. And implied volatility on things like corn, wheat, and soy has not been especially out of line recently. Looking at, say, 1 month ahead options. But when you look over past periods of La Nina in the subsequent year or two, a La Nina beginning, often you see implied volatility maybe 25, 30, even 50% higher than normal across corn, soy, and wheat. So I would keep an eye on those sea surface temperature anomalies across the equatorial Pacific. They can have a really big impact on crop yields in South America for corn and soybeans over the North American winter, so over the South American summer. And they can have a lot of potential impact on the planting and growing season, even going into next summer. So I would keep an eye on that.
Well, since you asked so nicely, Eric, we'll squeeze in really quickly a little bit of ags. Wheat was number 4 to the dark side this week, listeners, off about 1 2/3%. So we'll hang our hat out there. Coming into showtime, wheat here at about 581 and a half, almost over half actually, 57% of the paper coming in this March contract for next year has about 72 days to go. The ags, they like to have those certain focus areas of liquidity, and clearly March is a big one out here right now. If you're wondering, contract-wise, about 34,000 contracts on the tape, so fallen somewhere above silver, but below gold, and some of the other ones we just talked about recently. See, about 57% of the paper in the March contract. The vol, by the way, if you're wondering out here, Eric was just alluding to the vol and ags. The vol at nearly a 23, up about half a point here. That is a little bit juicy for all things wheat. Skew-wise, the puts were about 2.5% cheap to the at-the-money last week. This week, about 1.4%. So puts get a little bit of a bid. Calls, 5.6% rich last week. This week, 8.4%. So calls firmly getting bid in the ags. Not a lot of shifting of the skew, so that wasn't a big movement of the skew curve. It was up the skew curve, so that's kind of interesting. Again, play with that shift and slide tool there, listeners, if you want to learn more about that. And the most active contract out here, I said we're at about a 581 and a half. Coming into showtime, it was the 620 calls in March, leading the dance with about 3,000 contracts on the tape. All right, listeners, it's about that time. Time for you guys to take the reins, a little bit of your futures options feedback.
It's time for your questions, comments, and insights. It's time for Futures Options Feedback. Submit your questions at twitter.com/options, facebook.com/The Options Insider, stocktwits.com/Options Insider, or via questions at theoptionsinsider.com. You can also submit your feedback via our Options Insider Radio Network mobile app, available for iOS, Android, and Kindle Fire devices. You can even ask your questions live via our Mixlr chat room. So grab the Mixlr app or just search for Options Insider at Mixlr.com. That's Mixlr.com.
All right, everybody, welcome to your segment, the Futures Options Feedback. We're kind of coming up against this, so we'll dive right in. We got time for, this is an epic one, so maybe only one. This comes from Rhythmic Angel. I like that handle. He asked, or perhaps she, they want to know about spread prices versus outright futures prices. My question is around trading systems like TT that show calendar spread prices for crude oil futures, let's say. When you hit the bid or ask on these spreads, it sends 2 orders into the market for each of the calendars, correct? Because there is no calendar spread future at CME for crude oil. It looks like a TT offering. In that context, the spread you see for this price you see for those spreads are not the same as if you had sliced the spread prices to see what the outright months are. For example, if the crude oil March price is 50 and the April price is 51, the March-April spread showed by TT wouldn't necessarily be $1, but it could be anywhere close. Therefore, the question is, because the spreads by TT are traded the most, I think you said more than the outrights. How does the exchange actually discover the outright prices? Do exchanges keep track of these spread prices that are, to my understanding, an offering by the trading platforms, not necessarily by the exchange? Let me start off with the caveat that I haven't used this platform in a while, so I'm not familiar with the exact TT offering that you're talking about here. But this is not a new phenomenon in the brokerage space. Brokers sometimes try to imply liquidity by creating their own kind of custom products and offering insights into that do exist, that are trading. We see this all the time on the equity option space with these different types of spread books and spread offerings you see at different brokers that are taking the liquidity implied by the MBBO on one contract and the liquidity implied on the MBBO on one other contract and giving you this awesome spread price that doesn't really exist in the marketplace. And you try to trade it, and lo and behold, it's not there. We get that question all the time. This is a related one. Now, there are a variety of different spread contracts out there. There are monthly WTI spread options, and of course, WTI Brent is an active one. You're right about the monthly futures spreads. I don't see those on there. So it sounds like this is a TT offering, in which case sounds like your assumption is correct. They are going to just interpret what they're seeing on the screen, because at the end of the day, it's driving more darts for them, right? They can find a way to source and show you more liquidity, maybe in a different way than you're thinking of. It works for them. It obviously works for CME because they're getting liquidity in action in both of those futures contracts. So brokers do this a lot. And it's not going to exactly line up. It usually is not the case because they're kind of making a Franken product, right? It's not really what's trading out there. So you probably could do it better if you legged into it yourself, but then you have leg risk too. So they're trying to maybe offer that and maybe take some of that risk away and putting this product together that drives a little bit more action. I'll have to kick the tires for myself on this particular offering there, Rhythmic Angel, and see if I have any further analysis of it after I've used it. Eric, I'm not sure if you have anything to add on this particular functionality, but more any thoughts on maybe just in general what's going on with the WTI spread market? Any interesting research? Could be WTI Brent or maybe some of the intra-month spreads that you keep an eye on, sir.
I think the WTI intra-month spreads are really interesting. And so, to me, the oil market's reaction to the vaccine news was really weird. Like, I would have thought that the back month contracts would have had a big rally, right? But instead it was a front month contract, so it really moved. So it was really the very near contracts, like the March contract, for example, March 2021, it had a really big upside price move. That was probably because of OPEC, in fairness. It wasn't just the vaccine. But even the market's initial reaction to the vaccine before OPEC really came into play, it was really good for the near months, which to me is kind of interesting because the vaccine's not going to have any impact on travel for probably at least until April at the very earliest, because it won't be until April that the general population is likely to start being inoculated. And it may even really be more like July or later next year when a large portion of the population hopefully gets inoculated and things really start going back to some new normal. To my mind, the real risk in oil is probably pretty much at the back end. That once demand for travel starts surging, the oil producers might be slow to respond to that. By that time, oil inventories might be at much, much lower levels. Maybe, we'll see. And that's when you could really see oil maybe in 2022, 2023, going back towards much, much higher levels. And I'm not sure that's really reflected necessarily in the markets right now.
Good stuff. Unfortunately, that music means we'll have to leave it there. We have come up against it, listeners. But before we go, let's go back around the horn. Let's start with you, Mr. Norlанд. While you and Blue and the team over there at CME are cranking out all kinds of great research, all kinds of great, interesting products. Maybe you want to give our audience a little bit of a hint of a little bit of a tease of what you're working on next, sir. Now is the time. The floor is yours.
Right. So I think one of the things we're working on is a paper on what happened to inflation. Inflation has been dormant for the last 26 years. This may be in part why a lot of your listeners aren't so into trading U.S. Treasury options, why they focus maybe more on equities or precious metals or oil or even ags. But I think inflation is a very, very interesting story. So what happened to it? What happens if it comes back? And that could potentially propel that sort of maybe less exciting Treasury options market to become a very, very exciting options market at some time later this decade.
There you go. Check it out. Eric and Blue and everyone else's research over there. Go to cmegroup.com. You know where to find it. On the education tab, it's all there under economic research. If it isn't pumped up, they put them on the homepage all the time, too. So usually it's not hard to find their research. Just be cautioned. Once you go down that rabbit hole, there's no going back. There's a lot of great data there. You'll be looking at it for hours. cmegroup.com. Click on the education tab. While you're there, you can also hit the podcast tab. Find a little show called TWIFO. Just putting that out there in your ears as well. And before we go, Mr. Sean, obviously small caps, kind of all the rage these days. If folks are interested in what's going on, they want a little bit more data, maybe a webinar or two, where should they go? What should they do, sir?
Well, thanks, Mark. And Eric, just a quick note to you. Just a real pleasure to be with you on the show. And it's always great to listen to your economic views and outlooks. It's just fantastic, great information. So thank you for that. I really appreciate it. And great to talk to you today. Back to small caps and Russell 2000. We've got $9 trillion benchmarked to our Russell suite of products here. But the small caps have been the index to really look at. And we talked about it on the show as being an indicator of a strong indicator of the U.S. economy. And Eric brings up a lot of very good points in regards to why those small caps are more volatile. And there's certain things that could happen this year that can drive the market higher, and there's some that will add some volatility to that market as well. But back to FTSE Russell and for some information, if you go to FTSERussell.com/blogs, you'll see some really good recent blogs on Russell 2000 making history in these rallies. There's a nice piece on the November to remember U.S. small caps this past November and the incredible rally that the index had. Also, there's a very recent global outlook for 2021, and will the vaccine be a shot for market rotation? And what does that mean from a global economic perspective? That's presented by our Philip Lawler, head of global investment research. Eric, you might even know Philip. I don't know if you do, but if you don't, you two should absolutely be in contact with one another. Happy to do that for you. But again, if you need me, I'm at sean.smith@lseg.com. Happy to, if you guys just want to reach out to me, but go to that website, FTSERussell.com/blogs, FTSERussell.com/webinars. Lots of fantastic information, relevant and timely. Thanks, Mark.
There you go. FTSERussell.com is the place to go. Give him a follow on the old Twitter machine as well, at FTSE Russell. And on behalf of Sean, everybody over there at FTSE Land, and of course Eric, everybody over there at CME, and indeed myself, I want to thank all of you out there for downloading, streaming, subscribing, for joining us live on. I know we threw your schedule a little bit of a monkey wrench this week. We'll be back at our normal time next week. And, of course, we'll be back tomorrow with all sorts of fun. There's still a lot of Education Wednesday in store for you today as well. You already had Options Boot Camp this morning. OPR is coming at you later today. Tomorrow, got the second episode of the Option Block, Friday Volatility Views. Then it all kicks off again next week, all the way to Thursday, and another episode of This Week in Futures Options.
This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This Week in Futures Options is also brought to you by FTSE Russell, a leading global provider of benchmarks, analytics, and data solutions. Investors in the U.S. and around the world are using FTSE Russell indexes to benchmark their investment performance and create investment funds, ETFs, structured products, and index-based derivatives. Many Options Insider Radio Network listeners will be familiar with the Russell 2000 Index. Russell 2000 futures and options are currently trading on the Chicago Board Options Exchange and CME Group. For more information, please visit ftserussell.com, cboe.com, and cmegroup.com. This broadcast is intended for informational and educational purposes only and does not constitute trading advice or the solicitation of purchases or sale of any futures or options. The rulebook of the applicable exchange should be consulted as the authoritative source on all current contract specifications. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.